we're going to record this, so let's get the recording going. Okay, excellent. We're recording. Thank you, everyone, for dialing in to JF Capital Advisors Unplugged. I'm sure everyone is webinared out. I've participated in about a dozen over the last 5 or 6 weeks, and I've listened to probably 100. So we're going to do our best to make this topical and interesting and not a repeat of what you've heard elsewhere. And I was just telling Nick as we were dialing in that I said if we have more than 150 registered for this, I'll wear a tie. We've had 460 people register over the course of the last week. I think some won't make it live, so we're doing the recording. And before we get into anything, I just want to stress and reiterate, and my lawyer friends on the phone will be happy with this, but this is not transaction advice. Don't make a transaction or a deal or rely on anything that we're saying. What we're going to provide is a Q&A on a lot of topics that are illustrative, that we think are useful. We're going to share what we're seeing, what we're thinking and doing, but every situation is its own, is unique, and please rely on your own advisors. If you'd like to call us offline to talk about something or email us, feel free. So JF Capital Advisors, I'm Jonathan Fallick. I started in 2004. We're a strategic and capital markets advisory firm focused solely on the hotel sector. We traffic in what I would call complex things. If something is simple and easy to do, no one calls us about it. People call us with complicated things to do. We have a very active business in the field of asset management and owner representation, where we asset manage 10 hotels and do advisory work on another 25 or so hotels for owners that usually are not full-time in the hotel industry, but are in other real estate asset classes or other businesses. So we're basically an outsourced function of their team. In addition, we've historically and currently we structure and negotiate a lot of debt and equity and mezzanine financing. We do a lot of repositioning and restructuring of individual assets, portfolios, and public companies. We've done a lot of operator and brand selection searches. We've done a lot of ground lease structured transactions. So we're everywhere in the transaction advisory and capital markets advisory business. Over the last few years, we've also done a lot of litigation support and expert witness work for arbitrations and litigations. So on with me is Nick Mellis, who's a vice president at JF Capital. He has an illustrative career in the hospitality industry. He's a Cornell Hotel School guy, and I'm not. I've never been to the campus. So between the two of us, we think we know almost everyone in the hotel industry. Whether that's good or bad, we'll figure out at the end of this coming cycle. Nick is going to do a Q&A, and I'm going to answer, and he'll interject a few things along as we go. And what we're going to try to do is not, again, like I said, not repeat what you've heard everywhere else on other webinars or updates or memos. So Nick, take it away.
Yeah. All right. Thank you, Jonathan, and appreciate everybody taking the time to join us this afternoon. We have quite a lot to cover over the next hour, so let's go right ahead and jump in. All right. So Jonathan, first question is on working capital and cash. Generally, what are most hotels and most hotel owners doing with regards to property taxes, brand fees, vendor bills, and even insurance? Are they paying these now? Are they pushing it off until business rebounds? What are you seeing?
So that's the question that everyone's asking. What do you do and how do you do it? Before I get into it, we'd like to give you a very quick message from the newest intern at JF Capital Advisors.
Listen up, folks. You cannot pay your debt service with RevPAR index.
So you missed I was going to say you missed the end of that, but that's the key. You cannot pay your debt service with RevPAR index. That's Ryan, our 11-year-old intern out of the JF Capital Advisors Union Square temporary headquarters. And basically cash is king, right? So anything that you can do to stretch out payables, you're seeing operators and owners do. Anything you can do to collect receivables, even at a discount, you're seeing people do. Pushing off fees, figuring out working capital forecasts, what's in every reserve. All of a sudden, people have pulled out the cash management agreements and their bank accounts and are trying to reconcile every piece of paper that they have. So cash is king. That said, there are a lot of hotels we're involved with where if we have $1 million of accounts payable, we're taking a look at, do 90% of the actual number of payables, not the volume, but the number, relate to local small businesses. And in that case, we're doing our best to get the local small businesses paid, because we definitely, number one, we think it's the right thing to do. And number two, we think it's good to have them, and will be good to have them around as we relaunch and reopen. So everyone is scrambling for cash. The reality is it's very difficult to build a forecast as to what your cash will look like, because different municipalities and different states and regions are going to reopen and relaunch at different paces, and no one knows what the true demand is.
Got it. Thank you. Next question relates to labor. So how are hotel management companies generally dealing with layoffs, severance, and even furloughs? How's this being managed at hotels around the country, and how is it different from market to market?
So there's two separate questions here. One is at the actual property level. So management company employees that are an employee of the Hilton, Suburban, whatever. A lot of those employees have been furloughed. Some have been laid off, but a lot have been furloughed because no one really knows how long they'll stay shut or stay on limited service. So at first, a lot of people were put on 30-day furlough or 60-day furlough with ongoing benefits. Now we're seeing a whole bunch of people think about, well, in 60 days, I'm not ready to recall everyone, and getting into the analysis of what sort of severance may need to be paid and what kind of ongoing benefits need to be paid. A lot of what drove some of those decisions as well was, if we kept people on payroll but with limited salaries and less hours, they might be ineligible for unemployment. And one of the things that we found is, and I don't think, I'm not sure this was intended, or it might have been intended by Congress, but there are in many cases employees who can do better between now and July by not working, collecting unemployment, and actually have a better financial outcome than by working full time. So, there's this weird situation that we're in right now. And in fact, in a few of the hotels that we have open, we've actually increased the pay of those employees that remain so that they're not worse off by coming into work. And again, I think that will unfold a little once we get into August, September, October, into the fourth quarter, and going forward, when the unemployment benefits won't necessarily be there or be the same. Then at the management company level, you've seen the big brands have done massive furloughs and massive furloughs of people. So they've eliminated essentially a lot of positions. The independent management companies, for the most part, have eliminated very few positions. They've kept their core operating teams together. In some cases, they've dialed down social media or e-commerce or things where there's just not a lot to do right now, but their operating teams, their finance teams are in place. And we've seen that especially the case with the independent management companies that have sold a piece of their equity, either majority stake or minority stake, to capital partners. So they're better capitalized, and they're actually looking at playing offense here in terms of buying other management companies or picking up other management agreements, whether through lenders or owners. So, it's being dealt with in different ways all over the place. There's a whole separate webinar we could do on what's happening in the union markets, where there are union employees as well. That gets into a whole series of other conversations.
Right. And you mentioned the fact that a lot of your hotels are closed. If you had to estimate, what percentage of hotels across the US do you think are closed? Is it mostly full service hotels? And how are hotel owners making the financial decision? Should I close or should I continue to stay open even if I'm, at occupancy that's in the teens?
So it's a good question, Nick. It's a really good question because the statistics you see published on the number of hotels closed is very misleading. There are a lot of hotel like if you have to bifurcate the primary urban markets or primary resort markets from the suburban and the secondary and tertiary markets. You have to bifurcate the big box group hotels from the 100-room residence inns. So the vast majority of the large group houses are closed or are functionally closed. They might
Hmm.
technically still have their doors open, but they're pricing their rooms inventory such that their occupancy is extremely low when they're operating with very limited staffing. So you're seeing published statistics that somewhere between 15 and 20% of the hotels in the country are closed. But if you look at what of that, what of the institutional quality hotels, what of the
Hmm.
major urban markets, what of the major resort markets are closed, it's a much higher percentage. So a lot of the roadside motels are open. A lot of the
Sure.
budget and hotels are open. There was a second part of your question. So what? Oh, that was what? How do you make the decision to close or
Right,
not
right.
close? So a lot of go into that decision. It's very difficult, and one of the most challenging things here is it's not like there's a 60-day or a 90-day period when we know we're going to be beaten down, and then we've lagged that, and all of a sudden we're back in action. You know, no one has any real clarity as to when business transient demand really comes back, when group demand really comes back, when leisure, even though everyone thinks leisure will bounce back, when it truly comes back. And the
Right,
reality the reality of all of it is when you shut down a hotel, you still have a lot of ongoing costs. So a lot of
right,
people have thought through, have done the analysis and have thought through. If I shut down, I still have to have the general manager, the chief engineer, security. I still
right,
need someone to close the books. I still need someone to talk to accounts that are calling about rebooking their events, about inquiring about, is our ballroom available for a wedding in December or next year? So there are
right,
ongoing labor costs, and then there are ongoing other operating costs such as utilities and other
right,
contracts and contract services that you can't just turn off overnight. So
right.
they may go down, but you can't turn them off. So generally, the analysis is if you can stay open and contribute positive GOP, it may make sense to stay open. That
Right.
said, in many cases, we've essentially split the difference, where we've stayed open, but we've shut down the food and beverage operations, we've shut down the spa and the fitness centers, we've gone to basically a rooms only operation. Where we're not doing daily housekeeping, we're doing a very thorough cleaning of the rooms before someone checks in or after
Right.
someone checks out. We're cleaning the public spaces, but it's really a very limited kind of service operation.
Got it.
And as a result, we're a lot more nimble. We're a lot more nimble, and in a few of those cases, what it's done is it's allowed us to actually pick up some government contract business. Where if we were closed, we wouldn't have opened
Sure.
in time, but we happened to be in certain markets where there were needs for blocks of state government business, and we picked it up, and all of a sudden we have hotels that were running at 15% that are now running at 85% occupancy.
Got it. Got it. Got it. Great. My next question. So if a hotel owner elects to close, what does the staffing plan look like in order to continue to keep the building safe and to make sure that whether it's in 60 days, 90 days, whatever it may be, that the hotel is in good shape to reopen?
So there are
Who needs
many
to be on staff?
pieces. Yeah, Nick, there are many pieces to it. And there's the what's the immediate obvious payroll cost, right? So if you think you're going to be shut down for 2 years, you don't really need a general manager. You
Hmm.
don't really need a director of sales. You'll handle all of that through your management company's corporate office. But if you think you're going to
Sure.
reopen sometime in the next few months, you need the base team there in order to rehire, retrain, reach out to customers, reach out to vendors. So even with a shutdown hotel, in shutting down, you're still going to have security,
Hmm.
some of your
Hmm.
maintenance folks, because you're going to need to watch the plant. the general manager, maybe an accounting person, maybe not. It depends if it's centralized. But just shutting down is not as easy as snap your fingers. You've
Right.
actually got to go and figure out what's in the rooms,
Hmm.
what's in the kitchen, what do you
Right.
have that's perishable, what's going on, what's going on temperature wise, and what zone are you in? If you're in a humid environment and you come into
Hmm.
summertime and you just shut down and don't have air circulation, you're going to have a huge mold problem when you reopen.
Sure.
If
Right.
you shut down and it's winter time and you've got frozen pipes without water running through them, you're going to have a problem. So you need to constantly monitor the equipment. You need to monitor what's going on. And in shutting down, if you're going to be shut down for a while, as you deal with whatever inventories you have, as you secure whatever whatever product you have. You might have a lot of liquor inventories, you might have
Hmm.
electronics, you might have various things. You need to figure out how to keep everything secure and safe. And then the next part of your question, I think, is then you think about reopening. So reopening requires restocking on inventories, staffing back up, putting people back on the payroll, doing marketing, getting back online with Expedia, with Booking, with
Hmm. Hmm.
all the brand booking channels, which takes a few weeks to do. So it's not as easy as
Sure.
snapping your fingers and all of a sudden you're in. And then one thing that a lot of people are not really focused on is, if you think about opening a new hotel, right, the pre-opening budget for a limited service hotel could easily be $700,000. It's a lot of labor and training and getting
Hmm.
organized and building a brand presence. And for full service hotel, it could be anywhere from $1.2 million to several $1 million. So technically, we've already made sure that door locks work and
Sure.
PMS work, but restarting involves a lot of expense and a lot of working capital in advance of when the demand is really there and when you're going to start to really collect revenues.
Got it. Thank you. For the next question, I want to talk about the brands quickly. So generally, how has Marriott, Hilton, Hyatt reacted to the pandemic? Are they providing any types of concessions to hotel owners? How have Marriott brand standards changed or Hilton brand standards? And
Sure.
what level of support are they providing currently?
So thanks, Nick. I'll get into the brands and what they're doing. Before that, I want to do our second quick message and learning lesson from our JF Capital intern, Ryan.
I wish I was in a hotel. I've been trying to get room service every night, but it's not been working out so well.
So thank you, Ryan. It's definitely not working out that well, though I know he's eating fairly well. As a practical matter, the brands have been very accommodating. They've been very quick to allow owners and operators to reduce the previously mandated brand standards. They've
Mhm.
been saying, okay, you need to cut your F&B, you need to cut room service, you need to do only room service. You need to not clean rooms on a daily basis. Whatever it is you need to do, go ahead and do. They're being very protective on fire, life safety, and security and life safety issues, but
Sure.
otherwise very accommodating. If you need to use FF&E reserves and get their approval, to use FF&E reserves for payroll or critical working capital needs, and
Hmm.
many cases they've been okay. If you need to extend PIPs or QA deficiencies, they've been okay. Now, part of the reason why they've been okay is, the brands have furloughed or laid off, substantial amounts of their own staff. So, they have suspended, and again, this is a generalization, not at any specific brand, but they have reduced or suspended their field marketing, their loyalty program marketing. They've reduced their e-commerce functions. They've reduced their revenue management functions. Group sales is nowhere to be found. National sales is nowhere to be found. So, they're there kind of protecting and preserving and doing the things they need to do for their own survival. But because they've cut a lot of their own resources, they've been fairly understanding in terms of what hotel owners are doing.
Hmm.
And the The real test, Nick, is going to be as we relaunch, right? What do all of the individual brand standards for sanitization and cleaning turn into? How much incremental cost are those?
Yep.
How does that really work? Because the product, the cleaning products and procedures will require more spend on product cost and more spend on whether it's housekeeping or maintenance, whoever is cleaning the rooms, whoever is cleaning the public spaces, however things are being disposed of or distributed, is going to add incremental cost. So how are we going to handle that? And I think one of the things that will, and you, most people have heard of this on other webinars, is I think we're going to see the end of we know it in terms of daily housekeeping. Most people that I know do not have daily housekeeping at home. Most people that I know do not use a towel or a washcloth once and throw it on the floor and it gets laundered. So at a point in time, as we rebound from this, I think you're going to see the elimination of daily housekeeping. It might factor in once every few days or just after each stay. So I think you're going to see a lot of efficiencies, both technology and other operating efficiencies triggered by this and accelerated by this, because as an industry, we need to. And it's taken, unfortunately, it's taken crises in the past for the hotel industry to get more technologically proficient and to get more efficient.
Got it. My next question, on a federal level, how has the PPP loan process been working out? How has the rollout been going? And lastly, are there any unintended consequences of the program as it continues on as a second wave or whatever that kind of may be?
So in a normal year, right, in 2019, I don't have the exact statistic, but the SBA did less than $30 billion of loans throughout its programs in all of 2019. Here they came out with plans to do, 349 billion in phase one, and then a few hundred billion more, and there's probably more to come. So, the intent of the PPP program makes a lot of sense. Some of the execution doesn't make sense. There's been a lot of changes in the guidelines and the interim rules and regulations as to who qualifies and who doesn't qualify. So a lot of it is misleading. That keeps changing as we go. And then one of the biggest challenges we've seen is most institutional hotel owners and a lot of smaller, just entrepreneurial hotel owners have mortgages on their properties. And in almost every loan agreement, there's a concept of permitted indebtedness, which is the mortgage loan and maybe something else that's known as of the time of the mortgage loan. And if you take on additional debt, even if it's unsecured, even without guarantees, without the lender approval, that could trigger an event of default under your loan, and it could trigger recourse under your bad boy non-recourse carve-out guarantees. So we're in every case that we've been involved with, we have gone to the lender, and at least asked and said, hey, we want to do this and take it. We'll use it for the prescribed purposes, making payroll, paying utilities, paying rent, paying debt service, but we don't want to be in default. And we've been very successful with most lenders, though we've had a few lenders that came back and said, and put conditions on it and said, yes, you can take it, but if the non-forgiven portion of it is not paid off, by the maturity date of the PPP loan, then all of a sudden your entire loan is going to be recourse, and it's going to trigger an event of default, which effectively turns a non-recourse loan into a recourse loan. In some cases, the lenders have been stretching to get there. We haven't seen that out of balance sheet lenders, but we've seen that out of some special servicers, not all, but some. And we've seen other, bells and conditions put on it where, not paying back just that amount becomes a personal guarantee of that amount to the lender, not to the SBA or not to the government. So it's working okay, but not effective for some. And then the way the forgiveness works, it's good to get some additional working capital, but the way the forgiveness works, you end up basically having 8 weeks from the day you get your funding in order to spend the money on payroll and payroll related. And if you have a closed hotel or you have a hotel and there's no real demand, in theory, you could hire back or bring back a bunch of your employees, keep them on for 2 months, and then furlough them again. And then there's some issues in terms of, do you qualify for the forgiveness? So, I think the intention out of Congress was good, but an 8-week period just doesn't work. That period needs to be extended through, through September, October, or even the end of the year if the intention is really to get people at work. So
Got it.
it's working, but it is additional debt, and if it can get forgiven, that's great. Some people will do very well with it. A lot of people just can't touch it based on how the rules and regulations are written.
Got it. So I want to go next to the lending side. So what are hotel owners communicating with their lenders at this time? What are they asking for? And generally, have lenders been willing to work with them? If so, when do they say, you know what, enough is enough?
So different people are having different conversations. I'll talk about the first group, and this is kind of the minority, and we've counseled them strongly against this. But the first group are those that say, you know what, the asset's very impaired, the loan's impaired. I'm going to go tell the lender or master servicer and special servicer they should write the principal balance down by 30% or 40% and suspend all my interest payments and let me use all reserves and not put me in cash trap mode. And for the most part, that's a losing proposition at this stage because the lender or the special servicer sits there and says, why am I going to take a whole bunch of pain and concessions and, and write down my loan or give you concessions? What are you putting in? How much cash are you putting in? Number one. And number two, show me a forecast. Show me an operating projection and a cash flow forecast.
Right.
That shows me why I can't, why I should actually take any write down of my loan or why I should give you any concessions. I mean, I understand, no lender is blind or clueless to the fact that air travel has screeched to a halt, that group travel doesn't exist, business travel doesn't exist, and leisure is, very minimal. But how long is that, right? If you keep watching CNBC or other things and people talk about V-shaped or U-shaped recoveries, why would you take any kind of write down? And then the next question becomes, okay, borrower, or owner, give me a projection. Give me a monthly projection for the rest of the year. Forget about 2021. And no one has any clarity and ability to do that. The only thing that good operators and owners have figured out how to do with a fair amount of precision is to figure out what their burn rate is, what they're actually going to spend if they're closed or functionally closed, right? May have one floor open and limited staff just sort of waiting, because there they can measure the payroll expense, the property tax and property and casualty insurance expense, security, other stuff. They may have some sense of receivables on the books that are being collected. So that they can do. So the vast majority of requests to lenders and special servicers has been something along these lines. Number one, give us 90 days of forbearance. Just waive our debt service for 90 days. And the lenders have mostly responded with, we're not going to waive it, but we're willing to defer it for 60 or 90 days, because then we'll have another discussion when hopefully you have the ability to do a projection and there's some clarity. The next part of it is let us use cash reserves, FF&E reserves, seasonality reserves to pay payroll or even to pay debt service. And for the most part, that's being granted. One of the requests is allow us to take a PPP loan or other similar government assistance program, and that for the most part is being granted. A lot of requests are, don't put me into a cash trap mode, cash sweep and hard lockbox mode if I was not already there in December or January, right? So don't impose even more challenging restrictions and restrictions on the uses of cash that we have for this period. We're seeing, and that's for the most part being granted. We're seeing requests for extensions in financial reporting for, audited financials and for guarantor reporting just under the circumstances, and seeing that be requested. Those are the biggest ones that we're seeing. So it's kind of like a Band-Aid. It's a 60 to 90 day, we'll kick the can down the road. It's a shorter term version of the extend and pretend program that we saw in 2009, 10, and 11, which, was questionable at the time, but worked out quite well for most borrowers and most lenders. Not all, but most.
Hmm.
You know, that's the primary discussion that we're seeing. You know, lenders have been very willing, and asset managers and special servicers have been very willing to work efficiently, you know, and in a collaborative manner with those that I would call good borrowers, right? So someone who pre-COVID has been paying their debt service on time, submits budgets on time, you know, does their certifications on time. Like
Hmm.
they're not creating problems. And where there will be problems and actions will be taken more swiftly are those who are either bad borrowers, those who say, I'm not putting another cent into this, I don't care, you can take it, you can have it, you know,
Hmm.
and they're in default.
Right.
You'll see some actions, you know, taken there by lenders and servicers. So
Got it.
it's a mixed bag, but you know, for the short term, you're seeing lenders cooperate significantly. And then in the public markets, if you watch the public REITs and the public C corps, you know, there they typically, for the most part, they have revolving credit facilities and term loans. They have a syndicate of bank lenders, and
Hmm.
for the most part, uh, they have been granted. The public companies have been granted 5 quarters of covenant relief. So through March 31 of 2021, where they don't have to satisfy the financial covenants, but they may have some other restrictions on what they can do. So they're,
Got
you
it.
know, they're in kind of hunkered down mode, but very few lenders are looking to penalize the borrowers. Now,
Got it.
in 90 days, you know, as
Yeah.
certain
What happens?
markets open up and as people think more, then there's going to be some more discussions. And what's going to win, you know, what's going to be a winning proposition for a borrower in dealing with lenders is the borrower's willingness to support the asset and the loan. So if the borrower says, hey, I need more concessions from you, but I'm going to put 5 million of fresh equity into this deal, you know, half of it for working capital and half in a debt service reserve,
Hmm.
that's going to get the lender's attention.
They'll be willing to
Now,
play ball.
that
Got it.
won't get the lender's attention on a $400 million loan, but on a, you know,
Right. Right.
on a reasonably sized loan, that'll get lender, you know, that will get lender attention. You know, but we're going to get into the point where, you know, lenders aren't going to forbear forever.
Hmm. Hmm.
So things will start to unwind or get a little contentious for some. You know, starting in another 45 to 60 days from now.
Got it. Thank you. The next question I had relates to the large hotel unions, such as in New York. So generally, how have they reacted to the large number of hotel closures? Have they generally been willing to, you know, work with hotels and hotel owners? And do you think that most of these hotels in the major markets, such as in New York, will eventually reopen?
So it's different in different markets, right? In some of the markets in the country, you know, there are a number of hotels with union agreements, and the local unions are fairly reasonable. You know, they want to protect the employees from a safety perspective. They want to protect the health benefits and make sure there are jobs. In some other markets, the unions have been very aggressive in demanding. Like one of the things that, you know, people saw publicly in New York City was the union went for an emergency arbitration, saying, you know, we need ongoing health benefits and we need severance payments. We need severance payments when all these employees were furloughed or laid
Hmm.
off, and you know, and they literally went for an emergency arbitration for this. You know, right after this was happening, and you know, the impartial chairperson in New York City, who's far from impartial, you know, ruled, yes, I'm going to give you, you know, I'm going to give you another 4 months of, I think it was 4 months, it might have been 6 months of health benefits, because he
Yeah,
saw
four
that in
months in New
one
York,
case that was settled,
six
four
in
months in
Jersey.
New York, because he saw that in some case that was settled, and he said, I'm not going to opine or rule on the severance because, you know, we don't know when things are coming back, but, you know, come
Right.
back to me and see me soon. So, you know, so that's fine for the union to go and advocate for their employees. No issue there. However, if you're dealing with shutdown hotels where there's no cash sitting there and the owners don't have cash and they've shut down big box hotels in New York City, you know, where's the money coming from? Where's the cash coming from to make
Right.
severance payments and make all these payments? So, you know, the biggest question is going to be from the unions from the unions in terms of how much, sorry for some background ringing, a bunch of people working out of this satellite office here that we call home. So the biggest question is going to be how cooperative are, the larger hotel unions going to be on reopening plans where operators and owners are going to have to be very nimble, are going to have to manage their staffing reasonably well, are going to have to, share job tasks, and rules of engagement, just in terms of dealing with customers are going to change. So like there's not going to be a lot of appeal for bellmen. What do you do with a bellman? There's not going to be, the same demand for multiple servers in restaurants if everything goes to grab and go, or, for room service servers if, everything goes to a call, place your order, and come pick it up. Now, I don't think we're going to live in that environment for years and years, but for the next year, it looks like we will. So, there are going to be a lot of issues where large urban group hotels either don't reopen anytime soon because the cost of reopening, in and of itself is huge, and then layer on the existing union contracts and the work rules and wages, and it kind of doesn't make sense, and the union's going to want to renegotiate housekeeping credits because it'll take longer to clean a room. They're going to want to renegotiate all sorts of different rules. So that's going to be a work in progress. And as a result, I think the last part of the question you asked, Nick, and we're getting asked this all over, is a lot of the big box hotels in major urban markets, especially union operated hotels, I don't see them opening anytime soon. Or if they do, they're not opening their F&B. They're going to reopen a 1,900 room hotel with 200, 300 rooms open for transient, and low occupancy, but they'll be running like a limited service hotel. So I think the union contracts are going to slow down big box, urban hotels and some large resort hotels from reopening, until you really see meaningful demand back, and that means group demand, and that's a while.
Do you think that a few of those hotel owners begin to look at possibly a change of use?
We're in discussions with a number, and the most obvious change of use is converting to multifamily. So if you look at a big box urban hotel, and you think about it, every room has windows, every room has plumbing and electricity. If you knock a wall down in between, 200-300 square foot rooms, you have a 600 square foot studio.
And
you have to do a little bit of work, but you have the elevator transportation. You have the electric. You don't have a gas line running into the unit, so it's not something you could convert it reasonably efficiently. Not the way you would purpose build a new multifamily apartment building, and then you end up with all the public space, all the ground floor space, all the meeting space, all the kind of restaurant and back of house space that you rent out. Right, you condo off, and it becomes third-party retail. Some of it you keep for amenities. So, I think if you were running a low margin in New York City, like some of the big boxes, like the Sheraton, the Hilton, the Marriott Marquis, you're running low EBITDA margins, and running like half the EBITDA you were running 5 or 6 years ago. That's something to very seriously consider, and it's something that we're looking at in the major urban markets. We've run models on it for people and had discussions, because the highest and best use in many of those cases is no longer hotel. Now, in doing that, you have to deal with the severance and the shutdowns. You have to deal with change of use in the municipality. But the real question is going to be, how long can they stay closed? How long can they stay closed? Paying property taxes and security and insurance and some ongoing staff stuff. So there's a lot that goes into that decision, but I'm fairly certain, there are very few things I'd bet on. I'm fairly certain that a whole bunch of urban hotels with heavy union contracts are not going to reopen as hotels, or if they do, are not going to have 1,000 plus or 700 plus rooms. They're going to have a fraction of that and have other uses.
Right, to look very different. Thank you. So the next question I have is that, assuming a hotel elected to close down, how does a hotel owner know when the time is right to reopen? Are there several key metrics that they should be paying attention to? Should they be looking at their competitive set? What should they kind of be looking towards?
So, Nick, that's kind of like asking me the question, in the last few seasons, should I bet on the Jets or the Giants, right? And, neither one was a, particularly good shot at winning, right? So the reality is, and I'll apologize, I'll apologize because I see we have attendees on here and dialed in from Smith Travel and CBRE and PwC and Hot Stats and Calibri, so and I might have missed out on some of the prognosticators, but the reality is the data that we're seeing is very misleading, right? You want to reopen when you think the demand is there and will be there, and when you can make a positive profit contribution towards your fixed costs, right, including property taxes, insurance, debt service, etc.
Sure.
And the reality is no one knows. No one knows. We don't have a lot of forward bookings. A lot of group bookings that are on the books were either booked a long time ago and haven't canceled or postponed yet, or were set for April, May, June, and got pushed further out into the year, and they may not actually happen. So many things will factor into that, such as what are the airlines doing? What
Right.
sort of airlift is there? What attractions in different markets open up, right? So we're based in New York City. If Yankee Stadium is not playing to fans in the stadium, throughout the summer, with 80,000 fans in the stadium and another 15,000 people there, that means there's not like a lot of other tourist attractions will not be there and open. Is the U.S. Open going to play? In Flushing Meadows, when does Madison Square Garden reopen for
Right.
concerts? For concerts and other events. When can you go see a Broadway show? When does Broadway reopen? So many things, that impact what's coming into the markets. And then when you look at the reported statistics, right, and you look at the occupancies and you look at what's happening, it's all misleading. And I know that because we have some hotels that, we have big blocks of like government contract business, that's there, on a month-to-month basis. And we have some where we still have some crew business, but it's been slowly dwindling down, right? Because airlines are flying, they're just not flying as much. So where we would have had 30 crew people there before, we have 5 or 6. So
Right.
we're seeing a lot of things show up, with misleading statistics. And then the way Smith Travel aggregates the data and determines whether a hotel's open or closed, you have to look in detail at the Smith Travel data aggregation and reporting rules and guidelines to determine if your numerator's right, if your denominator's right, and then
Right.
what's happening in your comp set, not in your comp set. If all of a sudden a lot of rooms in your comp set came offline because the building was shut down, that's different than if they came, that if they're online, but the local hospital system took over your entire property.
Sure.
So the data that we're getting is very misleading.
Right.
And we also don't know what's going to happen from an occupancy perspective when multiple hotels all try to reopen at the same time.
At the same time. Sure. Got it. Thank you. And building on that, so assuming that you make the decision to reopen, what does it cost to bring the hotel back? How long does it take?
Yeah. So I touched on that before, so I won't get into it in detail, but it requires a working capital infusion or injection because you need to bring back your staff, right? You need to reinspect and probably reclean the rooms. If you've had rooms that were empty for a month or so, right? You've got to deal with dust. You have to deal with whatever the brand or operator or municipal post, COVID-19 safety and sanitization procedures are. You've got to make sure your linens are there. You've got to make sure your PMS system is working. Turn your marketing back on. So there's meaningful costs in turning back on and ramping back up. In a lot of cases, you're just going to have to take existing employees, but have to train them on the new protocols. So it's going to take some time. And, if you decide you want to reopen, to do it efficiently takes about 2 to 3 weeks. You could do it overnight, but you won't have all your brand channels ready and all your marketing kind of won't be synced up and your employees won't be in the right place. So, you're going to see some reopen quicker than others. Some will take a more measured response. Some want to see, some are nervous about their employees. So there are multiple different things going on.
Got it. Thank you. The next question I think a lot of people on the webinar are also wondering, which is when will hotel transactions begin to open back up again? When will the industry finally begin to see the real distress that everyone has been talking about?
So, Nick, we've seen this in each cycle. You know, when we get walloped, in each down cycle, demand shock, we get walloped, and and you get the calls like you and I have been getting over the last 5-6 weeks, which are, I've got $1 billion of capital. Like, where do I back up the truck?
Right, right.
And my response to most of those people is, take your truck, park it somewhere in the suburbs, real cheap, and come back in 5 or 6 months. And the reality is, there's very little incentive for either a borrower or a lender to overreact or act very quickly when they don't know, the extent of any reopening or bounce back. They don't know the extent of additional government intervention. You know,
Mhm.
so so, not a lot of distress stuff is going to happen very quickly, even though 2 months ago, on kind of a pre-COVID basis, there were 75 hotel loans that we could tell were in CMBS special servicing. Fast forward 1 month, it's 750. And I think when we have all the remittance data, for the May payments in the next few days, it's probably going to be 1,500 that
Right,
are in
right,
special
right.
servicing. Now, not all of those are in default. Not,
Mhm.
plenty of those are current, and have paid cash current, but there's a risk of imminent default, or they need some sort of help or forbearance, and they need the special servicer to do that. So as a practical matter, most of the distressed sales, either note sales or property sales or foreclosures that you're going to see in the next few months, in the next 90 days, are hotels or hotel loans that were in trouble in December, right, on a
Right.
pre-COVID basis, or where there's a huge immediate cash need, and the borrower's just thrown up their hands. They've said they've done the jingle mail, right? And for those on here that don't remember what jingle mail is, that's you're a borrower, you put the keys to the property in an envelope, you send it to the lender, and when they pick up the envelope, it sounds like keys jingling. So but it's basically handing the keys back, and then someone has to fund the working capital or the insurance premium or
Sure.
the ground rent expense. As a more practical matter, you'll see transactions start to open up once there's even on a distressed basis, once there's some price discovery, once people can actually create some level of projections that they can believe in, and what will trigger the majority of loan sales and asset sales and rescue capital deals is a fairly immediate need or a fairly short-term need for an infusion of cash into the property. And for the same reasons I just mentioned, if you need that money to pay the ground rent expense, and otherwise the ground lessor is going to come and default you and collapse the lease, that's immediate. If you need to do something from a fire and life safety system perspective, it's immediate. As we re-emerge and the brands, mandate certain things, that could be very immediate. So as a practical matter, in most of these crises, you don't see a lot of things happen very quickly, right? In the fourth quarter of 2008, you saw very few hotels trading. You saw very few hotel loans trading. You get into 2009, also not a lot of individual distressed hotel loans that sold. What you saw were big blocks of loans that were sold by the banks to private equity and hedge funds with seller financing attached just to clear their books. But we're in a place right now where the commercial banks, are in much better shape from a capitalization and liquidity perspective and credit quality perspective than they were in prior cycles. In CMBS world, in 2007, between senior CMBS debt and mezz behind it, you could borrow 90%, or more. And we did that. We had one deal where we borrowed 96.5%, on a $750 million acquisition. We have not seen that here. So deals are much better capitalized to begin with. And it'll take time. You will see distressed transactions because there will be a reset on values somewhere lower. There will be cash needs. There will be brand requirements. But we see very little of that happening, in the next 90 days. We think you really
Got
need
it.
price discovery.
Got it. you talked about this a little bit, but what is going on with the special servicers now in CMBS, and how does this differ from balance sheet lenders or even the couple of debt funds out there?
Sure. So I wanna turn to kind of one more video instruction that we got from Ryan, our JF Capital intern.
Oy vey. I've been trying and trying, but I can't get in touch with the special servicer.
Thanks, Ryan. We've gotten lots of calls from people who have had that issue, and it's not that special servicers are being elusive, and there are a whole bunch of participants on here right now, of the several hundred dialed in that work for special servicers. The special servicers have received an avalanche of requests, of loan files transferred, and every borrower is sitting there kind of with the working assumption, oh, well, they've been the special servicer since the loan was funded, so they must be 100% up to speed on everything that's going on with our loan, with our cash flow, with the collateral, with the waterfalls. And they're in the same kind of crisis mode. How do we deal with all of these things? So if someone is asking for very simple, I need approval to take a PPP, I want to use my FF&E reserves to pay debt service, and I'll pay, that's like really easy, right? Anyone who has more complicated requests, it just takes longer. It takes longer. They're not necessarily in the same hurry. Especially if a borrower says there's an imminent cash need. If there really is no imminent cash need, and maybe the borrower's not able to pay debt service, but they have enough money to pay working capital, to make payroll, and to pay their property and casualty insurance. They're not they're not acting that quickly. The special servicers in CMBS world also have limitations on what they can do. So balance sheet lenders and debt funds can be much more creative in taking participations, in extensions, in different kinds of cash flow sweeps. In amending and changing, key loan terms. The special servicers need to abide by the REMIC rules and the pooling and servicing agreements, and as such can, provide some sort of relief if it makes sense, but they can't negotiate, and cut a deal, even if it's in the best interest of every bondholder and certificate holder. They can't necessarily do whatever makes the most sense. They have to do what maximizes the value for all of the stakeholders in the securitization, but they can't necessarily do what a debt fund might do that has a longer term point of view and can better align interests with the borrower.
Got it. I want to go back to branded hotels quickly. So how should hotel owners generally be thinking about an upcoming PIP? So that's coming up within the next few years, obviously coming out of COVID and what surely will be some type of a depressed economic environment.
So that's a good question, Nick. I think we're going to do our last video from Ryan, the JF Capital intern. We have several interns. Ryan happens to be the youngest.
And the youngest.
And the youngest.
Pip, I'll show you a Pip.
So as a practical matter, PIPs are on hold, and the brands are okay with that. A lot of the brand standards are on hold. And by the way, we saw the same thing. We saw the same thing in 2009 and 10. The brands were fine deferring things for quite a while. They wanted fire, life, safety things done. They wanted certain things done. It's very difficult for the major brands to insist on owners spending capital when the major brands themselves are hurting and and have seen all of their revenue streams dry up. But fast forward 2 years, 3 years, you're going to see the brands sort of get reoriented as to what's really important, and you're going to see certain lenders say, I made a loan, with the expectation, I lent against a certain amount of collateral and funded a certain amount of dollars, assuming the property would be renovated and be up to snuff in accordance with brand standards. And even though the brand said, okay, defer this for however many years or eliminate this, you need lender approval. You need lender approval for that as well, because they were expecting a certain quality.
Thank you. This is the last question from me. Trying to end on a positive note here. So when things do open back up, and they will, which hotel markets and which market segments do you think will come back the fastest? Which geographies, traveler types, property types really stick out to you?
So, Nick, I don't think any differently on this than all the stuff that everyone's heard and read. The drive to leisure should pop the first, followed by some business transient in terms of timing of recovery, followed by small group, followed by large group. And I think there will probably be, even as, businesses reopen and some things turn back on, a lot of municipalities will still have restrictions on the size of group events that you can do. So if there's a limitation of you can't have more than 150 people, or you can't have more than 25% of your ballroom occupied, a lot of the big events are not going to happen. A lot of the conferences, conventions will get pushed off. Some will turn into smaller regional pieces. So, the reality is we don't know, but we do know that, what I do know is, this is unlike anything we've seen before. Everyone talks about unprecedented, but in 2009, when everyone was talking about this was the worst RevPAR performance since the Great Depression, we saw occupancies go from the mid 60s to the mid 50s. Here we saw occupancy go from the mid 60s down to single digits and now into double digits, without any evidence that there will be a massive bounce back anytime soon. So the first thing that needs to happen, in order to make much better projections and predictions is we need a readily available vaccine. I personally don't think that's going to happen until sometime in early 2021. And then once that is the case, and by the way, that might happen earlier, might happen later, but once that is the case, we'll be dealing with several years of recessionary economic environment. So, so we think it's not a V-shaped recovery at all. We think there'll be some starts and stops. We think there will be individual and portfolios that reopen, that work, that try, owners dip into their own savings, they even get some rescue capital, mezz or preferred, and, and they punch into the middle of 2021 and figure out there's still not enough demand. So, we think it's a much slower recovery. That said, if you're a Residence Inn by the Houston Medical Center, you haven't dipped that much and you're going to do fine, right? If you're limited service or extended stay, in a busy area, that's great. If you're a resort hotel in Hawaii and you're dependent on airlift and you're dependent on a lot of group in addition to transient, it's going to take a while to recover. Now, your asset value could still be quite good, but you're going to be cash flow poor for quite a while. And it's going to be difficult to see a resurgence of real traffic and activity without without a vaccine behind you. All right. So we have two separate crises to deal with: the health-related one, then a recessionary environment. So, Nick, we've got a bunch of questions that people have written in. I'll try to go through them very quickly.
Okay.
One is, who picked out my tie? And I know that the wife likes this one, and I showed it to her, and she said, yes, I like it. There's another that said, Nick, make him take the tie off, and Nick is not in the same room as me. We're socially distanced by by a few blocks, so that's okay. Then we get asked, post-COVID, will owners still consider brand managed hotels? Will brands still want to manage hotels? The answer is yes. The brands will still manage hotels. People will still have brand managers, but a lot will look up and say, hey, if I can go to an independent operator who can react quicker, who could be more nimble, I'm going to move in that direction. But, Marriott, Hilton, IHG, not to single anyone out, but, in assets that they consider strategically important and, large group boxes, they'll still manage and want to manage. We get asked, what are you seeing in terms of using PPP proceeds? Is there a chance of using them for expenses other than payroll? So technically, you can use them legally for interest expense, for utilities, for rent, but that doesn't tie into the forgiveness. What I think is going to happen is the 8-week period is going to get extended. I think you'll probably see that in the next bill that comes out or in some guidance from the Treasury and the SBA, because it's otherwise there won't be enough forgiveness and it'll cause another wave of debt problems. Let's see. I got to scroll down. We have a few more. We'll try to get to all of them. Do you see a second round of PPP funding or similar schemes? We're in the second round. I think there will be a third round as well. Then how does New York Union get through this? What are states that are net winners? The New York Union is going to fight with the New York City Hotel Union is going to fight with a lot of, they're going to fight with a lot of owners over, over costs and job positions and, how things rescale. And if they're not agreeable, to smart, intelligent things that protect workers, but also make it such that owners can reopen and make some profit, you're going to see a lot of the hotels either not reopen, or convert to other use, and they'll pay the severance and they'll go through the, either the rezoning or the permitting process, and they'll convert, and you'll see less hotels. Um, what percentage of hotels do you think won't make it out of this crisis? Uh, I think the majority will, but a bunch that won't are these big box group hotels or functionally obsolete hotels that have heavy union contracts, or just in markets where, just to restart and relaunch doesn't work. So anyone who is struggling on a pre-COVID basis is going to have a real tough time making it through here. But the majority of hotels will come back out. Some will come out very slowly, and some will convert to other use. New supply, we also think, will slow down very substantially. So anything that's not fully financed or in the ground already is going to have a tough time. We get asked, where are the biggest opportunities if you have dry powder in the next year or so? There's a ton, there are billions and billions and billions of dollars that the large private equity funds and hedge funds and institutions have. So they'll be chasing a lot of larger corporate portfolio, company level stuff. The best opportunities are going to come from individual, here's a $30 million loan, here's a $40 million loan. The borrower's in default, but there are a bunch of guarantees. You can buy the note and work something out with the borrower, or you can partner with the borrower and working something out with the lender. We get asked, how do we think about valuations now? Will lenders lend against replacement value given negative or depressed EBITDA? Hotel lenders won't lend against replacement value, because almost no one would build a new hotel to the state of like a 40-year-old hotel that's been renovated a few times. If you think about valuation generally, buyers right now are willing to buy, at a 30 to 50% discount. And sellers, for the most part, other than a couple of anecdotal issues here and there, are not willing to sell at that. They might be willing to sell down 10 to 15%. But if you engage one of the major appraisal firms, and we know a bunch of their folks are dialed in here now as well, and they run a 10-year forecast for their appraisal, and discount that back and assume that there's zero cash flow in year one, and zero to minimal cash flow in year two, given that there's a residual value calculation at the end of year 10 and it's discounted back, that would imply that you're down about 11 or 12% in value today, as a result of the COVID impact. If you believe that over 3-4 years, you'll gravitate back to 2019 numbers. So, so true value is probably not as impaired, but the hotels don't have a lot of liquidity. And lenders today don't really want to make new loans, right? They will for good existing clients, but absent price discovery and absent the ability to project well, it's a very difficult case to make. We get asked, will a lender consider a loan modification as part of an assumption on sale in the current environment? Balance sheet lenders, debt funds for sure, CMBS lenders, can and will, but they're limited in how much they can do. There's limited in how much they can do. Okay, let me see. I think we have one or two more, and then we're gonna wrap up. What are ground lessors doing, offering to their tenants? Almost nothing. They're waiting. What major changes in customer behavior do you anticipate during the recovery period and beyond? There will be lots of changes. I'm not going to pretend to know what they are. We're going to see how customers react to, being served in a hotel restaurant by someone with full headgear, covering, with gloves and masks and whatever. And I believe, once the COVID-19 health threat is behind us with a readily available vaccine, people will be sitting in bars, they'll be sitting next to each other. There'll be more of a focus on cleanliness and sanitization, which is good. I'm pretty pleased that after 96 years, they cleaned the New York City subway system, and that airlines are going to clean up more. I think that's pretty good. Um, we get asked, what options do mezz lenders behind CMBS and special servicing have? In many cases, not yet, but coming into the end of this year and into next year, most of those mezz lenders will be the fulcrum security. The equity will be functionally wiped out. If they have a 10-year time horizon and can feed the investment, that might be okay, but otherwise they'll have a tough time. And then the last question we'll address, we have a few more, but we'll deal with them offline. Would COVID be considered force majeure, and there's a good chance for franchisees to terminate the franchise agreement? So there will be lots of lawsuits, and there will be lots of letters that say that. I'll close by saying, once again, we're not giving legal advice, we're not giving tax advice, we're not giving transaction advice. Everything that we say is illustrative and meant to share some of the things that we're seeing. So rely on your legal professionals, tax professionals, operators, asset managers, etc. If you'd like to reach out to us and chat about your assets, your loans, situations you're looking at, reach out to me, reach out to Nick. It's nick@jfcap.com, jonathan@jfcap.com. If you look on our website, you can find our phone numbers and all of our contact information. We'd be happy to chat offline. We've come up on an hour and 7 minutes, so out of respect to everyone who is dialing in, we still have 200 people logged in, but out of respect to everyone and their timing, we'll wrap it up here, and we'll consider doing another one of these in a couple of weeks with a shorter list but more targeted topics. So thank you everyone for listening and participating. Thanks, Nick, for keeping me mostly on schedule. And everyone, good luck out there and stay safe. Thank you.
Thank you. Thanks.